Hello, everyone. Today is December 20th, 2024. It is 1:02 a.m. Singapore time. It's time for our weekly TradingLink's trading sharing session. Let's take a look at the market fluctuations this week. First, let's look at Bitcoin. After the release of the Federal Reserve's meeting minutes on Wednesday, Bitcoin finally showed a bullish pullback trend. The high point was $108,000. After midnight, the Federal Reserve's meeting announcement came out, and the market had already priced in the rate cuts. However, the Federal Reserve Chair still had a significant impact on the market. Currently, on the daily chart, the lower band of the Bollinger Bands has provided temporary support at $93,000. The overall decline reached $15,000. Such intense short-term fluctuations at high levels were within our expectations. A few days ago, we also suggested that many spot investors should wait and observe for a while until this pullback settles, because it's hard for the Federal Reserve to take drastic and rapid rate cuts. Such expectations were part of our plan. Once Bitcoin shows such a rate cut impact, and the dovish effect falls short, it will trigger a sharp decline. This will also be a correction for the past month and the past 20 trading days, where the prolonged consolidation at high levels has been a bullish washout. During this wave, those in the market still understand the possibility of liquidations in contract trading. There have been significant losses overall in the past 20 days. Our view has always been that spot investors can continue holding, but contract clients at high levels must be cautious. This kind of violent fluctuation within the range and breakouts at the upper and lower bounds of the platform require careful position management to prevent liquidation. The overall Bitcoin weekly chart also shows a technical need for a pullback. As you can see, the 5-week moving average is located at around $93,000 on the weekly chart, which serves as support at the 5-week moving average. Looking ahead, we may see a high-level consolidation in the next 2 to 3 weeks, with a gradually rising focus during this upward fluctuation. Once a breakout occurs, the previous high of $108,000 could be broken through, and the breakout distance might be the same as the previous surge from $67,000 to $100,000. Our expectation is that in the next few weeks, there will be an opportunity for a fast breakout to reach over $130,000. This is our view. The outlook for the spot market, of course, depends on the end of year and early year policy influences from the Federal Reserve. Additionally, with the possibility of Trump's re-election and his successful return to the White House, many favorable factors could have an impact, and there could still be a chance for a rapid breakout. That's the outlook for Bitcoin. Crude oil is still sluggish as usual. It is oscillating in a range above $67 and around $71.40. We have been advising against going long on crude oil for several months now, because, from any perspective, it is essentially a product that has been forgotten and abandoned by the market. There is no volatility, no trading volume, and no breakouts. It's just small-scale, rapid washout and consolidation movements. It belongs to intense fluctuations that lack momentum. As you can see, the daily chart shows very long wicks on both sides, making it difficult to form a clear trend or swing. Trading it is exhausting. Once heavily positioned, it can lead to frequent stop-outs within a short range. The returns are not worth it. As you can see, when the Bollinger Bands are drawn on the daily chart, the lower range is very small, making it a very unexciting product. It really doesn't live up to the title of king of commodities, and its performance is quite the opposite of the traditional image of commodity trading. The gap is huge. Therefore, in the past 2 to 3 months, we have completely abandoned crude oil as a trading product. We have reduced our positions and focused on other trades. Of course, this has not impacted our overall returns. Our returns can still be adjusted based on position size. Recently, our TradingLink traders have increased their crude oil positions by 1 to 1.5 times. This still does not impact our overall returns. Short-term fluctuations are still quite easy to capture. In the past, we never dared to take such large positions. Now, we can take positions as large as 6 to 8%. The overall returns have been quite ideal. However, it is not as easy as before, like the 70 to 280 short-term movements, which used to yield an ideal swing in just a few days. It was much easier to trade back then. Looking at the 10-day moving average for crude oil, there is hardly any fluctuation. The range is between $71 on the top and $68 on the bottom. the many years prior to May. Crude oil used to have large fluctuations, quick washouts, and rapid trend changes. This short-term fluctuation is still quite difficult for beginners to trade. Crude oil's characteristic is deep corrections and long reversals. The fluctuations are wide, and the trend changes are sudden and unclear. It's not like gold, which moves in one direction without turning back. Finally, let's talk about gold. After some meetings were held, which also experienced a quick liquidation, we personally believe that the liquidation pressure is not due to the fundamental outlook of the commodity itself, but rather the deep adjustment of long positions after the expiration of some futures contracts. After the expiry of some contracts last week, many long positions underwent deep adjustments. Many clients and traders faced significant losses during this wave, after futures were much higher than spot prices in recent days, and after the super bullish impact on Wednesday. Many investors blindly chased long positions at high levels. The most difficult part is, when prices returned to the moving average last Thursday, many traders still opened positions at the close. Indeed, there was a rebound towards the end of the session, but unexpectedly, on Friday, the decline was still quite significant. Now, as you can see, gold has been showing a pattern of pulling back to a daily low during the Asian session, and then moving either upwards or downwards in a range-bound manner, is very likely to lure traders into taking the wrong side of trades, which can lead to big losses. Ultimately, it can result in significant losses. The candlestick from yesterday had a deceptive high, after being blocked by the 5-day moving average. Many of the previous bulls adjusted their positions and turned into bears. Today, for the bears, there is an upward movement that traps positions. As you can see, the rise before the market opened has a high probability of breaking through the high from yesterday, as well as the high point from Wednesday, when the bearish trend started, at around $2,654 and $2,655. Once the price breaks above $2,655, it could signal that all the support from the bears has been harvested by the market makers. The market makers' ultimate support for the bear market is located at $2,680. Once it hits this level, it will be the ideal level for us to open bearish positions next week. On the upside, the key moving averages among the 5 main moving averages, 4 of them could be our best entry points next week. Today, it may not reach this level, but if it reaches this level on Monday or Tuesday next week, we can open positions together and aim for a close down at the weekly level on Thursday or Friday. Our view has always been that in the coming weeks, gold still has a chance to break through to 540 and possibly reach the 2,500 level. As for non-US currencies, the US dollar continues to rise at high levels, which is one of the reasons that is suppressing gold prices. Today, the minor adjustment on the daily chart has given gold a brief opportunity to catch its breath. It has made a quick upward move followed by a pullback. Non-USD currencies may experience a pullback next week or in the first half of next week. We still maintain a bullish outlook for the future, and there is still a chance for it to break the previous high of 108.54. This concludes our summary of several products this week and why the market has behaved in this manner. Especially with gold, it aligns with our previous overall view. Market makers are actively shaping the trend, with many washouts, false signals, and sharp reversals. There are also liquidations and rapid pullbacks. Once you get immersed in a certain market trend and fail to quickly recognize a market reversal, your profits may quickly turn into losses, or even larger losses. Of course, in such scenarios, you may end up with positions that are hard to hold on to. This might lead to forced liquidation. Traders might chase after orders or get caught in a bad trade. After being trapped, they might end up cutting losses. The overall volatility in the market has been quite large recently. As we approach the end of the year, next week marks the end of year close, along with the quarter, month, and week's closing. This is the end of year closing for annual charts. Volatility could increase further. We are also facing the year-end market dynamics. We recommend that most traders refrain from trading next week due to the extreme volatility of year-end market swings. We should avoid these irregular market fluctuations. This will help protect our overall yearly returns. Thank you for following TradingLink. We also hope that more insightful individuals will join us.